Okay, well, as I mentioned, we're expecting a few more, but I think we should maybe just go ahead and start. We are a small but mighty group today. So first, I'd like to welcome everyone to our water cooler chat. This is a series of very informal sessions that we've been doing to kind of promote dialogue and help get some information out about different topics. I'm Catherine O'Riordan, the Executive Director at the Ecological Society of America. And we have been raising money at ESA for many, many years. I'm sure it goes back quite a ways before my time. We raise money for a few programs, most importantly to support our student members and to help increase the diversity of our community. So today we wanted to talk a little bit about different kinds of giving mechanisms, donor advised funds, and some other and ways to organize your planned giving. And so we have a few speakers here with us today. First, before I launch into that, I did want to just mention that for anybody who's not familiar, the CARES Act, which was started, there was the CARES Act of 2020, and now there's the CARES Act of 2021, which addresses charitable giving and allows taxpayers to take $300 off for individuals. Even if you don't itemize your taxes, you can reduce your adjusted gross income by $300 for individuals and $600 for joint filers. And the other aspect of that is if you do itemize, you can take up to 100% of your adjusted gross income as a deduction in charitable giving. So those are special for related to COVID for the last 2 years. And then we wanted to just have a pretty casual conversation around this topic. So I'll introduce our speakers first, and since we're a small group, maybe we can go around and others can introduce themselves. So Norm Christense is here with us. He is previous VP for Finance for ESA, and he is a professor emeritus and the founding dean of the Nicholas School of the Environment at Duke University. Very well-known school, very important for many of our members.
And also former president, I might add. I concentrate on the VP for Finance piece, but Norm, you were our president too.
Right, it's also a former president. And we have another former president, David Wright, with us today as well. We have Jim Carpenter is here from Fidelity Charitable, and he's the vice president for charitable planning consultant at Fidelity Charitable. It's an independent public charity that helps donors support more than 300,000 nonprofit organizations he did tell me they're the biggest, with $51 billion in grants. And so he's a resource on charitable planning for advisors and their clients. He works mainly in the Great Lakes region. And we asked Jim to join us today to give us some of the nuts and bolts about donor advised funds, since that's what Fidelity Charitable does. So thank you, Jim. And then we have Richard Kellog, who is the president of Future Focus, and Future Focus is ESA's partner in promoting planned giving options. And so I guess Rich has been at this for a while, since 1998, has been supporting organizations through web content that provides customized web content to explain different kinds of planned giving options. So that said, we'll just do a quick round. So David, would you like to introduce yourself?
Sure. David Inoue, former president of ESA and also a couple of terms as secretary. I'm now retired from teaching at University of Maryland and living in Colorado, so I can be close to my field site. I still have a National Science Foundation grant for work that I'm doing at the Rocky Mountain Biological Laboratory, and this will be my 52nd year there.
Mhm. Great. Wow. And I think that includes several important long-term data sets.
Yep.
So, yes. Liz?
Hello and welcome everyone. I'm Liz Biggs. I am the CFO at the Ecological Society of America. And I have not been here for 50 years, but I have been at ESA for 24 years. So,
Yes, a lot of history there. John?
I wasn't expecting you to call me, so I was ready to unmute myself. I'm John Miller, Membership Director. Hi, David. We work really closely with all the fundraising stuff as well as it pertains to membership. I'm actually the least tenured ESA person on this call, which I find amazing, even after 3 years now.
Yes. Okay. Teresa?
Hi, everybody. My name is Teresa Murad. I am here today actually as a donor. Although I do work for ESA, as you can see from my background. I'm the Diversity and Education and Diversity Programs Director. But like I said, today I'm really here to listen about tax benefits. So I would like to learn more.
Okay, great. Thanks. And George?
Hi, I'm George Stephen. I'm the Administrative and Governance Assistant at ESA. I work with Catherine on any governance-related matters with the governing board, and that also ties into fundraising. And I'm going on my 3rd year here at ESA.
Okay, great. Thank you. So to kick off, I thought we'd call on Norm to give us just a sense of his experience in giving to ESA and why you give to ESA.
Well, maybe to start is why give to anything? And I think from my point of view, charitable giving is really all about how you like to make a difference in the world and what things you'd like to affect. ESA has always been important to me. It is my intellectual home. I joined when I started the PhD program way back in the early Pleistocene, and I have been, I guess, very much affected by the membership, the opportunities that it's provided. It's just been a wonderful organization to be involved in. Specifically, with regard to giving to ESA, I think that the change and the reason for particularly focusing on gifts here is ESA's commitment to bringing young people into ecology and facilitating that, and particularly important these days is diversifying our discipline and working really to recruit people of from a variety of backgrounds, ethnicity, and so on into the society, and the gifts that we give to ESA are particularly focused on that, and that matters an awful lot.
Great, thank you. I think many of us feel the same way about ESA programs. So maybe we could jump over to Jim, and he could share some of his depth of knowledge on donor advised funds, especially on the tax advantages of and how they work.
Sure, and thanks everybody for having me in. I feel like such an outsider. I'm the only non-ESA historic visitor on your call, so thanks for having me in. I want to come off of what Norm was just saying. Americans as a group are fantastically philanthropic. You guys are involved in fundraising. You may not get the sense of this because fundraising is hard, but Americans give about 2% of GDP to their favorite charities every year for as long as records have been kept. So we don't have the 2020 tax returns filed yet, but in 2019, that was about $450 billion that Americans gave to their favorite charities in the course of the year. The next countries on that list for percentage of the economy for charitable giving are the Canadians, who we all know are sort of Americans in disguise, and they all live within 20 miles of the border. But they're at about 0.7% of GDP. So in terms of sort of charitable drive as a piece of the economy, Americans are way off the chart compared to the rest of the world. They're just fantastic. And also reflecting off what Norm said, the vast majority of that giving is individuals writing checks or swiping their credit cards to support organizations whose mission is important to them. Their alma mater, their church, the dog rescue, whatever it is that's important to them. Americans are they're just off the chart, fantastically generous. And then our firm, our little corner of philanthropy, we are Fidelity Charitable. And structurally, the lawyers always make us say this, we're a separate standalone 501c3 public charity. We do have an administrative services agreement with that other organization called Fidelity, with which you might be familiar. But we are a separate public charity, started in 1991, exclusively for the purpose of providing donor advised funds. So that's my run in, Catherine, to getting to actually answer your question. So all we do is donor advised funds. And for those of you that aren't fully aware, what a DAF or a donor advised fund is an account at a public charity exclusively for the purpose of making further grants to support charitable organizations across the country. The origin of it was pretty straightforward. You have a significant donor. They want their tax deduction now, so they want to give money to a charity now. But they want some administrative strings attached. They want to consult with the charity for how those funds are going to get used, right? So the first donor advised fund was the New York Community Fund in 1931. And the donor takes the tax deduction on the gift to the community foundation, but then they create a sort of administrative construct or a side account next to the charity. And then that charity subsequently writes checks to make gifts on the donor's advice. So fast forward to now, what we have is Fidelity Charitable and many of our peers. There's probably 1,000 different public charities that have a donor advised fund program. But structurally, it continues to work the same, where a charitable gift can get made to the donor advised fund, which is a public charity. So that's when the tax deduction takes place. But then that charity is not really doing anything. They become, like Fidelity Charitable, we become essentially a transaction processor, and we hold the funds in anticipation of the donor advising us, please send $5,000 to the ESA because they need some money. And then we mail checks. So here at Fidelity Charitable, last year, we mailed about 2 million checks to 175,000 different charities across the country. So that's sort of what we do. The reason the donor advised fund exists, and Teresa, this goes to your question as donors, the reason the donor advised fund exists, in most people's, well, in a charitable gift, there are really two components. What am I going to give? And who's going to get it? And in most charitable gifts, probably 85% of charitable gifts, those are not separate. It says ESA on one line of the check, and it says $500 on the next line of the check. So what I'm giving is cash, and ESA is getting it. They are not separate. And then in March or April, You look in your drawers and around on your desk, and you try to find all of the receipts for your various collected charitable gifts, and you put them all on Schedule A. And in the new tax rules, you hope for the best, that you'll get past the $300, or you'll get past the standard deduction, and you'll get some tax benefit. But you've spent the year supporting these great organizations that are important to you. What the donor advised fund does for people is enables you to split the two components of a charitable gift. What am I going to give and when? And who's going to get it? And the reason for the split is, and you brought it up, in tax planning, in portfolio planning, in long-term wealth management and plan giving, there's significant discussions around what am I going to give and when is the right time to give it, that can be wholly separate of whether ESA or the Girl Scouts or my alma mater are my most important charities to me. Here at Fidelity Charitable, about 70% of the gifts into us that create tax deductions for our clients are appreciated securities, stocks and bonds from client portfolios, where it's the right time in their portfolio to make that gift, but their favorite charity may not be equipped to take, 17 shares of Facebook and then cash them in and turn them into usable, or Bitcoin contributions, or all sorts of funky assets that it's the right time and the right price for the gift, but it's not appropriate to give that thing to the charity. So what the donor advised fund does is enables the donor and the donor's accountant and financial advisor to put their charitable planning and its accompanying tax planning on one side of the ledger, and then have an entirely separate conversation about what the important charities are. Our donors at Fidelity Charitable as a group historically have supported about 10 different charities on average. Although last year was a tough year around the United States, maybe you read about it. And last year, our donors supported more than 12 different charities on average. So giving went way up. One of the interesting things about the donor advised fund, because it's in the nature of sort of longer term planning, donor advised fund people tend to have more in their fund than they planned on giving. They took a larger tax deduction this year or last year, and they fund it, and then they're going to do their regular giving, but it creates a sort of a charitable war chest. And what we saw in 2020, between the economic and food security crisis, some racial equity challenges, a clear recession, we saw a lot of challenges around 2020. And for people who were philanthropic, what we're going to see, and you'll see the numbers come out later this year, the donor advised fund users massively stepped up to the plate to make much larger or more frequent gifts than they had planned, because they had the money just sitting around in the account. They'd already taken the tax deduction. They didn't have to look in their checkbook because they had it in the bucket and could gift it out. So that's sort of in general what happens with the donor advised fund. A significant number of our accounts in the last 3 years since the 2017 Tax Act have been around donors planning their tax deductions versus their charitable giving. And many of you may have experienced this yourself. After 2017, the standard deduction, or the amount of that hits your Schedule A to create a reason to itemize and get good tax benefits, that floor was raised to $11,000 or $12,000 for individuals, or nearly $25,000 for a married couple. Americans are fantastically generous, but there are not very many who give more than $25,000 a year. Like, as a group, we have a lot of people that give. That number is pretty high. So what people discovered in 2018, that while they were supporting all of their favorite charities, they were not seeing any benefit on their tax return. So what the donor advised fund offers people that are planning, if you're going to give $5,000 a year to your favorite charities for the next 4 or 5 years, well, why don't you give $25,000 this year to your donor advised fund? Now you can take a whopping satisfying tax deduction well above the standard, and then dole it out over the same ensuing years to your favorite charities, and then reload and take a bigger tax deduction, and then dole it out to your favorite charities. The concept is bunching. We probably opened 15,000 donor advised fund accounts last year for people specifically who were bunching. And they do that using non-cash assets mostly. You look in your investment portfolio, maybe you bought some Facebook for $17 at the bottom of the market a while back, and now it's worth $250 a share. You can throw 5 shares of Facebook or 10 shares of Facebook into your donor advised fund. You take a tax deduction for the value that you give, a few $1,000s, and no one ever pays the capital gains taxes. So you get the sort of second tax benefit of not only the deduction for the stocks given, but the embedded tax problem, which is why people don't sell their stocks. The embedded tax problem gets vaporized because the charity sells the stocks and pays the taxes at the charity's tax rate, which is 0. Right? So all the money is available for the charities. So that's a key.
Can we jump in with a quick
Yeah.
question from, I wanted to jump in with a question from Teresa.
Please. Your
Okay.
guys are on mute.
Yes, thank you. So yeah, I must say this is quite enlightening. I didn't have some of the information in my head about the donor advised fund. So the first thing I noticed was that we could actually put in securities, and I didn't realize that. So does that mean that if we don't cash out the securities or during the time that we're not donating to a particular charity and it's sitting in the account, it continues to grow and it continues to gain, right? Yeah. So
It should come as no surprise that since we're roughly affiliated with Fidelity Investments, your donor advised fund has a collection of investment choices. They're of course referred to as charitable pool accounts and not mutual funds, but they look distinctly like some Fidelity mutual funds, which you might be familiar. So there's an opportunity for growth along the way. Structurally, if you give us individual securities, we will immediately sell them and convert them into cash. And then we'll follow the donor's advice. If you would like us to invest it in the pools, we'll do that. If you'd like us to just hold it in money market where there's no volatility, we can do that as well.
Oh, I see. So if we put them in the charitable pooled accounts, then what kind of tax implications are there then?
There are none, because when you gift the securities to the donor advised sponsor, say Fidelity, that is your charitable gift. You have transferred value to the public charity. They're going to write you a receipt for the value of the securities on the date given.
Okay, I did not
Now, if
realize
they get
that.
invested and it goes up, that's great. You'll get to give away more than you took a deduction for.
Right.
But you don't get any benefit out the other direction. You don't lose any either.
Right. No, sure. No, I mean, but that's the point, right? If you want to put it in the pooled funds, I mean, if you're going to use the securities and you're not going to use all the funds right away to give, you would hope that there's some opportunity for it to grow. So that's good news. And can you clarify real quick, what is the minimum to open a donor advised fund today?
At Fidelity Charitable, there is no minimum size to our accounts.
Really?
So everyone can play.
Wow, I did not know that either.
It's a scale business. And, because a lot of what we work with are fixed costs. And so we've achieved a level of scale that we just recently moved our minimum account size from $5,000 down to 0.
Okay, but I
will
assume
say
there are
that
fees.
There is a
associated.
minimum fee,
Right, okay.
right, which is $100 a year.
Okay, which isn't too bad, yeah.
It's not too bad, but so that's the minimum fee. So if you're going to have a small account, and the answer is the minimum fee, we charge it at the end of our fiscal year, which is June 30. So if you're going to have a small account, just grant it all out in June. So then we don't hit you with $100.
Ah,
Uh-huh.
interesting.
Good
Because we're
trick.
just a charity, right? I mean, we're not a sneaky money-making operation. We're still a non-for-profit. Richard, you had a question?
Actually, I was just going to add the advantage to a DAF is stock markets go up and stock markets go down, but not every stock goes up or goes down. So what you're able to do with those 17 shares of Facebook is diversify across the broad spectrum, and it adds better investment protection for the assets you've given. So that diversification can be an important benefit as well.
That's right. And you know, many of your wealthy, you know, your donors, certainly a lot of our clients, you know, they get wealthy on a single stock. Maybe they're employees of a public company and have, you know, all of their wealth tied up in a single position. But their tax exposure, if they want to sell any of those shares and diversify their portfolio, they're going to have to pay 20 to 25% in taxes on any of the gains. So we, of course, encourage them to fund a donor advised fund, create a large tax deduction, and that gives them some air cover to do some diversification in the rest of their portfolio. So there's a lot of uses, but it's, it all goes back to the same thing of separating the charitable tax deduction and what is being given separated from the ultimate recipients. They don't have to be separated very long. I mean, here at Fidelity Charitable, you can grant all the money out, you know, after a 3-day settle, right? If you give us Facebook, it's going to take us 3 days to sell the shares and get cash. And then if you grant it all out to ESA or the rest of your favorite charities in 3 days, that's fine. But we've facilitated that transaction, so you guys don't have to keep some brokerage account somewhere and monitor, you know, what came in and who's going to do the trades, which is what many charities have tried, and we encourage them to get out of that business. So most of our donors are quite active and give away somewhere around 20% of their account every year. It's really, it's pretty hot money. People are planning on their charitable giving.
And is there a minimum that you have to give away every year?
The IRS has no minimum. Our cohorts in the planning space are the private foundation category, and private foundations do have a minimum gifting standard, but the donor advised fund does not, and so the IRS has no requirements. All of the donor advised funds sponsoring charities like Fidelity or Schwab or Vanguard or a community foundation where you guys live, all of the sponsors have administrative policies around making sure that the funds go to work where they're supposed to. So at Fidelity Charitable, we expect people to make grants at least every 2 years. We don't want it. Get it out there. Get it to work.
Great. Great. Well, let's return to Norm for a minute. Norm, would you, I know you had to turn off your video, but maybe you could just talk a little bit about your experience, because I know you established a fund, a donor advised fund.
I've had the video off, but I need to remember to turn the audio on. First of all, I hope you all can hear me.
Yes, we can.
Some bandwidth problems here. And so if you can hear me fine, I'll go ahead. James covered a lot of the reasons that I have done this. The opportunity, particularly if for whatever reason you're presented a moment or the appreciated stock or a variety of things where you have more money at one time than either you need or want to give, then this represents an opportunity, that money aside. It has the benefit of at least the potential of earning. So it, in that way, operates a bit like a regular foundation. There are all sorts of organizations that do these, and certainly Fidelity, Vanguard, in our neck of the woods, the community foundations tend to be important, and there are a lot of not-for-profits that have their own donor advice fund, environmental defense fund, the Nature Conservancy, and you can set them up in those organizations. Typically, those organizations will require you to donate some minimum amount to that organization. So I think to disperse those funds is convenient. So, depending on, if you have roughly years to do that, and of course you can add to it through time. Maybe a couple of comments here on a, might call the downside, or at least to think about in doing it. Your money is a one-way street when you put it into a donor advised fund. So this is not like a 529 fund or some other kind of, this money, you've donated to a charity already. You just haven't named the charity, and that money is now there and can't be retrieved. And there is usually a minimum entry fee, which for many folks just it doesn't work well. It's just they're not going to have those resources on hand right away. I was going to mention one other device. It's sort of like a DAF, and those of us who are pretty well, and it has to do with the required minimum distribution, the so-called RMD on our retirement funds every year. Every year, if you have a 401k or something like that, roughly 5% of the value of that fund in the preceding year, you're required to retrieve that. You can set aside a portion of that as charitable giving, and the advantage of doing that is that you don't have to pay the taxes on that. So you save a little bit. It's nevertheless out within a year, so you don't have the 5-year benefit of that. But if you're retired and you do things like that, that's also a really useful mechanism. And these things aren't mutually exclusive. You can take that money from your RMD and put it into your donor advised fund if that's the way you like to work it. But just maybe one other nice thing about donor advised fund, and that is the folks take care of the donating for you, and it's say where you want it to go and for what you want it to go to, and the money gets sent in a nice formal way and easily acknowledged and easily taken care of on the in terms of just the records. So.
Yep.
So I'll take a breath there.
Okay, thank you. Yeah, I could see it, as I've just recently assembled all of my documents for taxes from last year. If there's one less thing to worry about trying to chase up what your donations were, that would be certainly very useful. So, okay, well, thank you. Any questions? David, do you have any questions about donor advised funds before we talk a little bit about some other mechanisms?
No, I've had one with TIAA, but they're just getting out of that business. So,
Oh, I didn't know that TIAA was in the business of donor advised funds. So,
well, yeah, they have been for at least a few years.
Well, that would make it. You could take your RMD and take a portion of that and move it straight into your donor advised fund there. I would imagine, but I guess not anymore.
You actually cannot do that.
Oh, you cannot.
In the RMD rules, where you can skim a piece of your required distribution off to a public charity, donor advised funds are specifically excluded from that rule. And it's easy to see why. What the feds are encouraging is putting money to work. And the RMD is all about getting it out of the IRA so they can tax you on it, right? That's the point. They've been waiting plenty long enough, and now they want you to pay your taxes. But they're willing to say, okay, if you're going to send it straight to charity, then you don't have to have it raise your income and then lower it back down again. You can shoot it straight across, but you can't put it in a weigh station. You can't put it in a bucket. It's got to go to work. That's the same logic of this year's 100% of your adjusted gross income is tax deductible, which is a great conversation piece. We haven't had anybody doing 100%. I have one planning client that it totally makes sense for them. I think they're gonna do it, but it's really special circumstances. But even in that, the donor advised fund is excluded because what the feds want is putting the money to work where it's needed right now, and they're willing to give this tax benefit. So it's the same logical construct as the RMD. And David is an old friend of mine and a former Fidelity Charitable executive who went and started the program at TIAA a few years ago, but they just didn't get to scale and have decided to push on. You can move your TIAA donor advised fund to your community foundation or to Fidelity or to some other place if you so choose. It's easy to just shift it. So.
Okay. Well, thanks. That was that's an important clarification, and I can see why they put those kinds of rules in place. But you really have to dig down to understand the intricacies of some of these, these rules of where you can move money to and where you can't. So, okay. Well, thanks. Rich, why don't we turn it over to you for a few minutes, and you can just give us the kind of the high level overview of some other mechanisms.
Thank you. It's a pleasure to be here. James, I'm also an outsider, so there's two of us. But Catherine mentioned that Future Focus is a partner in the development of the content for plan giving on the webpage. And if you'd like to look more at some of the things that I'll touch on, you can find a lot more depth through the webpage at ESA.org. If you go to the upper right-hand corner of the homepage, there's a menu item called Donate. And if you click on that, there's a sub-menu, and one of the 4 choices, I believe there are, is Plan Giving. And that'll give you a lot more detail, and you can perhaps look up information about a particular method. Plan giving is a general concept that covers a variety of ways to make a gift. Passion is the motivation for making a gift. Taxes are often the afterthought of, okay, how do I do it in the most tax efficient method? Because there's no requirement that we maximize our taxes. In fact, it's generally accepted that we're going to minimize our taxes. So there's a variety of ways that gifts can be made and that are called, in general, plan giving. Some are current gifts. Some are gifts that are after your lifetime. And some are gifts that provide income to you during your lifetime, as well as to the next generation, if you so wish. The most used planned gift, and this is something in excess of 80% of all planned gifts, is the very simplest. It's a bequest in a trust or will. simply saying at the end of your life, when you no longer need the funds, you intend to give either a specific amount or a percentage or the residual after all other gifts are made, and that goes to a charity. It's after you no longer need the funds, but it's also revocable. So it allows you to make a gift and yet still have control, in that if your circumstances change, you can change the bequest. It can be done either through writing a whole new will or writing a whole new trust, or simply adding an amendment or a codicil, which can be done very easily, and it's effective. So a bequest is the simplest and most widely used planned gift, but then there are a variety of others. Norm mentioned the RMD, the charitable, qualified charitable distribution that has to go to a public charity. And it is a way for those who have to take the required minimum distribution to avoid taking it as taxable income and then making the gift, which would not allow you to get the full deduction, but in general, but have it sent directly from your trustee to a public charity. And it's not considered income to you, but it is, and therefore it's not taxable, but it does satisfy the IRS's rule on required minimum distributions. Now, if you happen to be someone whose required minimum distribution is in excess of $100,000 a year, that's the maximum that you can do in any given year and benefit from the avoidance of taxes. Other ways of making gifts, James talked about appreciated securities. That is a current gift that's often used, and the significant benefit is that you're avoiding the capital gains tax entirely on the gift. And it allows you to perhaps give more than you would from current funds, because you're able to give something that is appreciated significantly. So appreciated stock, either as a direct gift or into a donor advised fund or into a charitable trust, is a significant plan giving method. Other plan giving methods are gifts of life insurance. If you've reached a point where you have paid up life insurance, but it's really the purpose that it was set up years ago really isn't as significant now that we've moved on in age and families are on their own and doing well. Perhaps a gift of life insurance to a charity where you make the charity the actual owner and beneficiary of the life insurance is another method of planned giving. And I did mention charitable trusts. This is a significant method that's used to avoid capital gains. It's used highly with real estate, where an appreciated piece of property is donated to a charitable trust. And that charitable trust then liquidates the property and invests the income. It does not have to pay tax on the capital gains. So all of the appreciation of the property avoids tax. All the funds are then invested, and the charitable trust pays a percentage back to you in terms of taxable income. So it's called a split interest gift, in that you will receive income for your life or a term of years, and it can be set up so that after calculations are made that pass the IRS regulations, it can be a second generation can also receive that income. But then at the death of the last income beneficiary, whatever remains in the charitable remainder trust goes to the charities that were established. This is an irrevocable trust. You can retain some control over it, but you cannot get the funds back. It was mentioned before, I think Norm mentioned the one-way street. This is definitely a one-way street. What you put into a charitable trust is going to charity, but you can maintain the right to change charities, to add or reduce, but you have to have all of the remainder eventually go to a charity. The significant advantage is that assets that are often difficult to market can still be placed into a charitable remainder trust. And they tend to be significant assets because there's a legal process that a donor has to go through. The trust has to be drawn up. And so generally speaking, the rule of thumb is roughly $100,000 of value is the minimum for in terms of the effectiveness of a charitable remainder trust. But the IRS rules are that a minimum of 5% income has to return to the donor. It can actually have no maximum, but there are calculations that the IRS has established that based on current assumptions guarantees that there will be a remainder in the trust for charity. It can be set up as a flat 5% of, for example, of the original donated amount, regardless of what happens to the funds, if they appreciate or decrease depending upon market conditions, or the payout can be a percentage of the funds. And in an increasing market, that means the income can actually increase. So today, in particular, we see a significant use in donated real estate, people who have had one or two additional rental units that they have set up as an investment over time, have seen considerable appreciation. And in some states, and in particular, I'll go to California as one, the capital gain tax would be extensive. It would be a little over a third of the appreciation by the time the federal and state capital gains are calculated. So a donor, or rather a charitable remainder trust, is an effective tool that, depending upon the circumstances, it can be used. But that's the real key, is there are a variety of ways that you can donate through what is called planned giving. But it's really dependent on your individual circumstances. And so while we can talk about the different ways to donate, it's really best for the individual to sit with a financial advisor and determine what really is best, because everything has its pluses and minuses. And so you want to balance that out as best you can. But I mean, that's a very brief and quick overview of planned giving. As I mentioned, there's more details on the ESA website, including a piece called, I believe it's titled, How Can I?, which gives you 3 columns. One column is, well, if I want to. The middle column is, then you can. and the right-hand column and your benefits are. And so you can look at a quick overview of about a dozen ways to make a plan gifts and what those benefits are for you. And I'd be happy to answer questions, Catherine, if anyone would want to have a little more detail.
Okay, thank you. No, that's a good overview. And, we're very happy to have that information available for donors on our site. I think it's a useful resource. And we have talked with you, Rich, in recent years about some of our strategies as well. I came from some other nonprofits, whereas the nonprofit side, we were given things like securities, that's not, your stocks, that's not so difficult. But we've been given property, and that's a little more difficult. As a nonprofit,
Yes.
we do kind of prefer getting the cash. Getting the checks in the door is a lot easier for us to handle, especially when we're small, like ESA is. So anyway, as long as our donors understand all of these mechanisms, we're happy to partner with them and offer your services to answer specific questions as well. So thank you.
Exactly. And you mentioned one thing that's a benefit to the organization with property. Donated property directly to an organization becomes the property of that organization. And if there's anything in it, if it was a Superfund site or something or a gas station was next door and suddenly there is a need, well, it becomes a liability of the organization. Whereas if it's donated into a charitable remainder trust, then that charitable remainder trust is the one that has to bear the liability, and it protects the individual charity from something unexpected down the way.
Mhm. Okay, well, thank you. That's a very good point. Next time someone calls and wants to give us their house, we're going to tell them to put it in a charitable remainder trust first. So,
Oh, yeah, I have a follow-up question. I guess I understand, you advise us to talk to an advisor, a tax advisor, and but I was wondering, in your experience, working in this area for so long, what have you found to be the key reasons to do one or the other? I guess, in terms of trying to help me think through some of the questions I would even ask a tax advisor, right? So what do you see? Yeah.
Well, again, it's individual circumstances. Is the money available? Do you need the money right now, or do you think that the assets are extra assets that you, unless something dramatic occurs, something unexpected, that you really won't need? And so that will often drive a gift. As I mentioned, bequests are the significant leader in terms of types of planned gifts. And that's because one of the benefits is that you're making a revocable gift. You're still retaining control. And it's a gift that is going to be after your lifetime. So should something happen in 20 years that's unforeseen, it's not a one-way street in this case. You still have access to use all your funds, and the bequest simply would not be realized. Or you can change your documents to eliminate the bequest. So it gives you great flexibility, and I think those are the significant reasons why bequests are so popular. The other methods are driven by unique circumstances that a gift of life insurance, if it's no longer needed or necessary in your estate plan. It was at one time, but now it's not as important. The desire to create income and avoid capital gains is what drives the charitable trust donation. There's another, by the way, deferred gift that's called a charitable gift annuity. That has to be offered by a charity that's gone through a licensing program. But it can be, and Catherine, this is something we might discuss, a community foundation can often and will often issue a gift annuity on behalf of another charity. And that would mean that the gift annuity, which pays out income to the individual during their lifetime, but the remainder upon their demise goes to the charity, would probably then remain as a fund in the charitable, the community foundation. The income from that would benefit ESA. So it's something that can be done if a donor said, hey, this is really what I want to do. And that's another, what we call split interest gift that provides income on a set rate dependent upon actuarial tables based upon the donor's age primarily. Does that help, Teresa?
Okay, well, great. Well, thank you. I think we're kind of at the top of the hour here. So I don't see any burning hands raised. So I think I'll just go ahead and thank our guests. Thank you, Rich, and thank you, Jim. And especially thank you, Norm, for taking time to tell us your story. And of course, always great to see you, David. But we have recorded this, so we'll have this available for people who want more information. And I think it's been very useful. I learned a lot. I took a whole bunch of notes. So again, thank you all for helping ESA and helping support our fundraising efforts. Thank you.
Thank you.
So long.
Thanks, everybody.
Norm, thank
Bye.
you.
Thank you.